Welcome to the Rebooting Show. I'm Brian Morrissey. I'm going to try different formats with the podcast in the weeks and months to come. I want to mix up the approach, feel like it'll keep it fresh. And I want to do different types of shows. But this week, I am speaking to Brian Hanley, CEO of Bullish Studios, someone who I got to know during the blissful days of 2021 when everything was a lot cheerier and frankly easier. Brian has started and runs a fascinating media business, takes popular meme accounts in particular, in order to build out media brands around them. Former Rebooting Show guest Liquidity partnered with Bullish in building out its newsletter offshoot, ExecSum. Bullish has also partnered with Mark Moran to establish a new kind of investor relations service. I regularly say there's no one future of the media business, and I think what Bullish is doing with individual brands, and particularly in the finance space, is a pretty good template, though, as we enter into what's sure to be another crazy cycle in the media business. Hope you enjoy the podcast, and if you do, please leave it a rating and review on Spotify or Apple. And while you're there, check out another podcast I do called People vs. Algorithms. Each week, I'm joined by longtime media exec and investor Troy Young and former head of design at Airbnb and CEO of Universal Entities, Alex Schleifer, for a more wide-ranging discussion on the interplay of media, technology, and culture. Check out People vs. Algorithms wherever you get your podcasts. And please email me feedback on either or both podcasts. My email is brian@therebooting.com. Now here's my conversation with Brian. All right, Brian, thank you so much for doing this conversation. I've been looking forward to doing this with you.
Same here, man. Thanks for having me.
All right, I think we met definitely during like the ZIRP era. It was down in Miami. I think where do we go? Maybe the Freehand or something like this. And you were telling me about making all this money off these meme accounts. And I was like, oh my God, this is crazy. For those people that do not know, what exactly is Bullish Studio?
Bullish Studio is a conversation about money. Basically, we're an interesting company. We like to say that we create some of the most entertaining and informative business, investing, and culture content. And the way in which we do it is a bit unique compared to, I think, a lot of other traditional publishers, but we can get more into that based on my experience, advice, and being a media buyer. But at the end of the day, we help make money off of content on the internet.
I know, but let's get into the meme stuff. The way you guys do it, you play, you're much more buttoned up than during the ZIRP here in Miami. But I mean, you've got like some very interesting properties, and like so. Explain exactly how you do that, particularly like I had like Liquidity on like I forget several months ago. We disguised his voice. It was kind of fun. And you know the whole I'm old, so like this meme world was totally new to me. And you know from what you were saying, like when you think about like what's going on in digital media, like there's a tremendous amount of attention that goes into places that that have not been, you know, monetized to some degree. What did you end up seeing? Because you know you've been in this game for a while. What did you end up seeing as the opening that ended up leading to Bullish? Yeah,
there was a few openings, I'd say. I think the first one that I really, you know, what opened my eyes was when I was over at Vice Media, where, you know, this was during a time where we were launching a ton of these different passion point led verticals, Munchies, Vice News, Noisy, all around different passion points. And we were kicking around this idea for doing Vice for finance. And there's a bunch of different reasons why. Obviously, there was a ton of audience that as the millennials got older, they had to care more and more about their finances, having kids. We're in the midst of a $30 trillion wealth transfer that's happening from, you know, our parents' generation down to ours, which is a ton of money and a ton of weird stuff happening. And ultimately, COVID was the gasoline to the fire. Before COVID, I would say that there weren't a whole lot of millennials that cared about the stock market or cared about investing. It just wasn't cool. But then ultimately, with stimulus checks and people sitting around at home, the rise of the day trader came back, and it just lit a fire onto this exciting little thing called the stock market. Wall Street Bets with Reddit bubbled up and took over with GameStop. That was when that all was happening. You were seeing every conversation on social media had to do with stocks, investing, making money. And that really was the impetus. And, you know, we started Bullish in February of 2020, right before COVID. And that was kind of the best time to launch it. And yeah. So, you know, what I saw was that, you know, you're having memes that are helping articulate what's going on. And ultimately, these memes were circulating, you know, people like Liquidity, Parikh Patel on Twitter, Ramp Capital. They're, when we looked at their numbers, they were doing hundreds of millions of impressions a month, and in some cases a day. And that ultimately was like, wow, like we are in the attention economy. We've been in it for a while. If these memes are reaching some of the most high value audiences, Bill Ackman on Twitter, we've got Chamath Palihapitiya, these are big investors. Where's the money? These are kids in their basements that are, memeing. How can they get paid for this? Because ultimately, we have to help monetize attention. So there was a lot that was going on. And, ultimately you have to weed through the bad actors and see who's going to be in this for the long run. And, our whole approach was let's partner with as many of them as we can. Building a media company this day and age from the ground up is a tough business.
Yeah, no, it's we'll get into that because like 2021 was like basically like a million years ago from 2023.
Oh yeah.
But I think what's interesting is that you saw like the attention was going, and there was a delta obviously between the attention and the money, but also more than the attention, like the cultural sort of relevance and stuff. And I think what's interesting to me is, finance was like hardly the area you would think of as like media innovation. It's kind of like how like Washington, D.C. is now like the place where like there's a lot of like really like interesting media businesses for a bunch of different reasons. Whereas like I always thought of it as like a backwater of the media business. No offense, Washington. But finance was always like dry and boring and stuff like this. And then there was this like explosion of these accounts. And maybe it was just happening that I didn't know. And like, like I remember like talking to you like and about like, let's like use Parikh Patel. Like let's just get into it. Let's go into like,
let's roll.
For those who do not know, I think he's a doctor, right?
Dr. Parikh Patel, CFA. Yeah.
Yeah, Dr. Parikh Patel, CFA. This is not a real person, correct?
No, it's an avatar. His image is a few different AIs smushed together. He first used a stock photo that he found, and then the stock photo model came back and was like, "Can you not use my face?" So he had to change it up. But yeah, we've got put in touch with him when he had like 5,000, 10,000 followers, and he's a unique individual.
And then basically he tweets like joking stuff. About finance.
Correct. And he also, like, he's I could speak high level about who he is as a person, but he's, studied in the financial category, interned in the financial industry, and has a deep understanding of it, which allows him to go and actually create content that resonates with a more high finance audience. And his voice and his ability to speak openly is what allows his content to travel. Going back to the point you made about like innovation in finance, if you look at Edelman's like trust survey, which looks at each of these different industries of like how typical Americans like trust, different, categories, finance is one of the least trusted categories compared to everything else. And the reason for that is that you've got websites and marketing departments that are literally run by compliance teams. If you're in the industry and you work at a Robinhood or a Charles Schwab, you cannot speak publicly about the company, about the industry, unless it's being approved by compliance. So it's really held back a lot of the like open conversations in finance, and it's really been held by the Bloombergs and the Wall Street Journals of the world. So this ability to have people that are able to speak openly and from a place of, experience is really where we're helping unlock a lot of that and change the financial media industry.
Yeah. And so, I mean, you run ads on these accounts, but you're not an ad network.
Right. I mean, look, your friend Troy Young has said that we are a very large niche ad network because we're basically helping scale advertising. Yeah. We're scaling, and I think this gets into like what Bullish does as a business is that it's not worth it for a company to go to one creator or one email newsletter and do a deal with, right? Because like that is just, it doesn't make any sense from a time spent standpoint. So we help basically work with hundreds and thousands of these different independent content creators and media owners and essentially represent them to the advertisers so that we can say, hey, look, if you're going after this particular audience, we have creators that reach that audience, and it's essentially we're creating that monetization layer between the brands and these creators.
Yeah, but it reminds me of Federated Media, though.
Totally. Just
in a different era.
Yep.
And now, talk to me about that, because like I always thought like Federated, which for those who don't know, like back in the old days, It was all these ad networks before the programmatic stuff. But like Federated came in and they saw a lot what was going on with the blogs. And at the time, and like, the blog explosion was happening, Web 2 and stuff like this. Places like Mashable and TechCrunch were like taking off, GigaOM and stuff. And they came in and they said, look, we're going to be our outsourced publishing solution, more than an ad network. Not like ValueClick and stuff like this. You could always plug in those ad networks, advertising.com. But they said, well, we're going to like serve the publishing function, which, as you know from your experience, is more than just trafficking ads, right? So explain, first of all, is that like a fair comparison? And then secondly, like, what do you do beyond quote unquote just ad demand? Don't get me wrong, like ad demand is very important.
Ads keep the lights on here. Look, we're an ad-supported business. We're a bootstrapped business.
Hey, here too.
That's
That's
it. Independent media, and we could talk more about VCs investing in media businesses. But ultimately, like, I saw a lot of advice. I watched that go from, low valuation to a high one, and it's like, you got to keep it lean and mean. So ads keep the lights on. And ultimately, that was our entry point to working with a lot of these creators. But to your point, that's fine, but we're not really building equity. We're not building like long-term value for ourselves or for these creators. But what we found is that we have a lot of experience in how to build media properties and, basically compounding asset. And that's ultimately what then helped us, that led into email newsletters. So we actually helped Liquidity, who I know you've had on, take his Instagram account and then, basically bring that audience into an email newsletter,
which is very different.
Right.
I mean, what Liquidity does, like on Instagram and stuff like this, is like, it's very meme, it's very jokey and funny and stuff like this. ExecSum, the newsletter, I get it. I read it most days. It's very bullet point. And it's very, made for a finance person who is looking to quickly scan and know what the heck is going on in the morning. It is not... there's a meme cleanser or whatever like this, but it's not all like ha.
Right. And then I think when you look at Liquidity as an entire, media entity, that is one component of the flywheel, right? So that's a way for him to diversify not only his audience, but also the way in which he speaks to his audience, so that, it's another spoke on the hub and wheel. And I think that's what we're helping with, that's what we're helping creators do. So whether they're a video focused creator, and helping them take that next step into being more of an operator to say, hey, look, like, you're doing all this great video. There's a ton of other areas to exploit to help expand the reach of that video content, whether it's opening up more distribution channels or helping with a partnership to get them on a bigger distributor. So we're basically able to use all of these different creators and represent them to these bigger distributors, these, other types of, avenues to explore to help them make money and build businesses. So we're excited about creators who are, committed to building businesses around what they're doing. But also, as I saw advice, and you've spoken a lot on this podcast about, is like, you got to be diversified. I watched 20 people get laid off because Mark Zuckerberg had the pivot to more friends and family connections in the feed, and watched, short form video on Facebook just get gutted. And that's where it's like, you can't put too many eggs in one basket with these different platforms. So you're always having to diversify. And I like to say, you got to run towards the CPMs. I mean, you look at the creator funds that are out there, there is nothing there. And I think it's hilarious to see, like, Instagram's like, brand collaboration marketplace just fail. Like, it's a tough business. 80% of creators' business comes from brand deals. So we're helping really open up that 20% and diversify that away from just being brand deals.
But you want to like do more, because I think, to go back to the Federated like example, and it's different. It's a different era and different blah, blah, blah. But at the same time, I remember when Federated was starting, at the time, like I was like, WeWork, right? And WeWork was just starting to take off. And I was like, I don't get this. I was like, why does our office building have a manifesto out front? I don't get this. And then, like, anytime I would like overstay like by a minute in the conference room, somebody would be irate and like banging on the door. I'm like, this isn't a community. What the hell are they talking about? And I was like, I cannot wait until the day we get rid of this and get our own office. I'm like, and I was like, this doesn't make sense as a business that their customers would celebrate the day they fired like WeWork. And I'm like, Federated in some way, to me, was victim of the same thing, in that like Mashable and TechCrunch and GigaOM, they used Federated to get to the point where they could just hire their own sales team, and instead of giving 50% or 40% or whatever the cut was to Federated, they would just say, hey, we're going to keep 100%.
Totally.
And that's a bad business.
And look, I think that touches on a very important component here where you're seeing a lot of other businesses that are in our world pop up where they're acquiring or buying creators. I do not believe that that is a way to be able to build long-term sustainable businesses. And, look, our model is built where people can come and go. But ultimately, if we see a breakout success, we really try to understand where can we as a company participate in the upside there. And I think an example of that is working with Mark Moran on building Equity Animal, which is a services-based company in the investor relations world that was built off of that. And that's something where, we're participating in that. And I think as other creators, we're helping launch their businesses, that's where we take our, more of a financial stake in them, because you've got the big VC money coming in trying to say, how do we invest in creators? But that's a fallacy. You're investing in businesses. So we're identifying, some creators just don't want to build big businesses, which is fine. So let's help them make money in the short term. And if that keeps going, great. If they leave, it's no harm, no foul to either side, and we don't really lose anything because that's what's keeping our lights on a day to day. So, I think we sent 300 1099s out to independent contractors last year. Obviously there's millions of dollars there. So it's like,
so you have churn, you churn
totally.
Through different, that's just the reality of a network
it's all
business.
built off trust. Right.
With things like Equity Animal and Mark, that's a totally different situation.
Totally.
Mark was working with Liquidity. I don't know, it was like employee one or something like this. Then they split up. I don't know. There was some kind of divorce. I'm not going to get into like the sort of meme dirty laundry. But it's a whole different world. But with Equity Animal, I remember you guys were doing some Twitter Spaces for there's apparently a publicly traded adult club,
RCI Hospitality.
I don't know what do they call strip clubs these days? What do they call them?
Adult entertainment.
Okay.
But
but that's different in that that is a true business venture,
right?
Yeah,
that's what we're looking for. We're looking for true business ventures. At the end of the day, those are what are the investable assets that come out of these creators, whether they're e-commerce stores, whether they're sustainable, subscription businesses. That's where the value gets created. It's not in the actual account. You need the account operator behind the keyboard every day and motivated to keep creating. And the second that you let them, de-risk by selling off an account, that's when the voice kind of fades away. And you saw that with Goldman Sachs Elevator. You see that in a lot of other examples where it's just it's the creative brains are what ultimately pushes that forward. And if they want to check out, we're not going to be the buyer holding that. We need that operator.
I do wonder about that. Because like you said with Goldman Sachs Elevator, I think we're in this era of disposable media
100%.
brands. And before in social media, I think I thought of it as a weakness of some brands. Now I'm starting to think this is a feature of just the world we live in. And maybe that's just how it is, that most brands are going to be to some degree ephemeral.
100%.
In the same way that fine, Bruce Springsteen's still playing Madison Square Garden, but most musical acts, they have a couple of good albums and then
that's it.
They fade.
We started a podcast called 25 Months, and it's this whole concept around the average creator only lasts about 25 months at creating before they burn out. They get a full-time job, they do something else. And I think, that's media. You see the rise. Media's on a 5-7 year cycle around media brands, and unless they can truly reinvent themselves, I think Barstool's a good example. But it is tough, and they fade away. And our business model is built assuming that that's going to happen. And that's why we've been going on for 3 years now, and I've seen accounts that we've paid a lot of money to, but the creator just wants to check out. They have a family with kids and a full-time job, and this was a side gig for them, and that's fine. So the cost of creating content is coming down significantly. And it has to just be profitable too. I remember at Vice, we'd spend tons of money on creating content, but I would scratch my head around, where does that money come back in? And that's where you have to always, the cost of content has to make sense for the monetization strategy that's built around it.
Yeah. Well, the good thing about memes is I think they're pretty efficient ways to create.
Very efficient.
I follow the, what is that, the
VC Brex?
meme. No. I follow VC Brags, of course, but like the meme theft account that calls out people. Like, I don't know. There's like, I don't know what the ethics. I don't know. This is actually about ethics and memeing. I don't know what the ethics of memeing.
I mean, look, Elon steals
like,
a ton of memes. Yeah, there was actually something interesting that I saw the other day about. I think it was Reformation or one of those brands where they were going out to a bunch of TikTokers that had viral videos, and they solely had the creator remake that viral video to word for word, but wearing the Reformation clothing. And then those videos went and took off. And the whole concept was like, it's just copying the same stuff that works, but hey, the creator's getting paid and everybody's getting taken care of. But it's the same that you see on YouTube. Everybody's following Mr. Beast. If you look at the stages of YouTube over the years, the content all molds with itself to the platform. Everybody's optimizing for what grows on the platform at that time. And if you're not keeping up with those trends, it's tough to keep growing.
But there's also, it's like something even like with Mr. Beast. Like, I wonder, like, I'm like, how lasting is this brand? Because, like, you know, he's obviously nailed this specific area. He's not the first person to be like a stunt account or something like this, and he has to continually. I mean, I'm kind of reminded. I'm getting like David Blaine flashbacks, right? Like, remember David Blaine?
Oh yeah.
Like, he was like, you know, he was like a magician, and I was like, okay, that's some good magic. We don't have a lot of magicians around these days, and most of them are like corny. And this guy was like, you know, quote unquote cool back in the '90s, and then pretty soon, like, he was doing like increasingly. And next thing you know, he's like, you know, in a coffin underwater for a couple of days or something, or you know, he was like being suspended in a glass box at one point in London, and there, you know, they got no time for this shit. So like, I remember one of the tabloids was like, had hired a miniature helicopter and was like flying like a cheeseburger like in front of his like glass booth because he wasn't eating for 36 hours.
Brutal.
Anyway, I don't know what my point is. My point is basically these things do have a shelf life a lot of times.
They do. And that's where I think when you look at Mr. Beast, I mean, if you look at the backing of him, he's got Knight Media behind him, which he helped co-found. So he's obviously participating in that. And Knight Ventures, they got Feastables. They're launching businesses, CPG businesses off the back of that. And I think that's where you're going to start to see those exits. You see it with the Nelk Boys and Happy Dad, Seltzer. Like, they need to get into other businesses to build that long-term equity that can be their own standalone businesses. They can use their channels to promote it. And then at some point, there's a really juicy exit because the value of Mr. Beast's YouTube account, there's something there, but without Mr. Beast, there's nothing. And if he gets hurt, if something happens to him, it's done. Like, it's a single person risk.
Yeah, talk about a risk.
Yeah.
I mean, and you also just, you have to, it's like kind of like the Jay-Z thing of like, you know, exiting to like, you know, to get in the background. Like, I mean, I think like I have a lot of like, I think Bill Simmons like was actually had a profound influence on digital media and was right about a lot of different things. Right. And like, I'm very impressed at his staying power. Because like I run out of it, like I like him, but then like sometimes I need to take like a year or two off. Like at some point I'm like, are we going to grow old together? Like I sort of sometimes think that's why I want like, I kind of, part of me wants Twitter to go away. Cause I'm like, am I going to be like, you know, tweeting at like 85? I really don't want to be. And I feel like the only way I'm not going to be if Twitter goes away.
It'll be an AI ghost version of you at the rate that all this is coming. I know you've been writing a lot about that. It's wild. But yeah, look, it's funny to see, like, you know, it's the platforms. They rise and they fall, and creators and media and media personalities go with them. It's a cyclical business. And if you could stick around, you're the breakout, especially for multi-decades.
Yeah, exactly. So let's talk a little bit about like the customer base, because like, again, like I joke that like, you know, we were at the Broken Shaker, you know, during a totally different era. Right. Mm-hmm. And like crypto was going crazy down in Miami, and like, you know, people, there was just like, I remember I did like a conference presentation at a time. One of my slides was just money everywhere. It was like, silly. I'm like, there's money everywhere. People were cutting, and crypto money was everywhere. And you benefited from that. A lot of people benefited from that. I mean, there's just so much money getting pumped into the system. I remember, I think it was liquidity. They started like, I don't know if you guys were this, they started a podcast, and we're like, yeah, I remember getting an email from Mark, like, yeah, we struck this deal for like, I don't know, like 7 figures I'm like, for a podcast? I was like, Can you introduce them to the Rebooting Show?
Money was everywhere. It was wild. It was a wild time. I mean, look, I think, and one thing that we like to always say is like we sell pickaxes.
How much of your business was crypto?
We had a good portion of it. Look, I'm not going to be shy. FTX was one of our larger clients last year. Thankfully, all of the work that we did was above bar, but it was and to be able to sit here and say that we could have done more due diligence is bullshit, because nobody could have done due diligence when you see Tom Brady doing that. It's the nature of the beast. But I think what we've always done is that we are grounding ourselves in being a bootstrap business. Every deal that we're doing has to make money and has to make sense. We've said no to 95% of the deals that we got that come across our desk, because ultimately the only thing that our creators have, that we have with our creators and the audience, is trust. So, we only focused on a lot of the entry points into crypto, the exchanges and some of the hardware security devices. We didn't touch any of that other funky stuff. But it was, you see the amount of money that was floating around. It was insane. And I think, as it's dried up a lot, you're starting to see a lot of companies, just go under because they ultimately could not get, the economics of their business to work. Their cost per acquisition costs were just way out of control compared to what they thought they could get by doing these affiliate schemes. And they read about how great Robinhood was able to grow. And it's like those days were over. And I think they had a ton of free money, and it was a wild time. We benefited from it, for sure.
Yeah. So, the come down must have sucked.
It was. Look, every business, every media business that was received that. Semaphores investment from FTX was a big oh shit kind of moment. Yeah. But yeah, look, the business contracted for sure. But that's why we're bootstrapped and we don't have investors to have to answer to, because when times are hot in certain industries, they get hot. Great, let's take the money, and we're able to live another day. Instead of taking on leverage at that point. And I think a lot of companies, love that leverage of taking on VC money, but then at the end of the day, the bill comes due. And I just get really worried about the amount of VC money that got pumped into media businesses, because then it's where's the exit? There's exits obviously, but I could be very careful about that.
Yeah, and it also just makes you do weird stuff.
Oh, totally.
We've seen this so many times, and just think about what refinery, could have been or would have been if it didn't have all that VC money, right? Now it's going to get passed off to some either private equity firm or some sort of vampire situation where they just, milk it for the SEO value, which is I always joke. It's to me, it's the hospice care of publishing is you enter into your SEO harvesting phase where you're just sort of hooked up and drained.
Rest in peace, CNET. CNET, money.com. It's unfortunately the way.
Brands don't die. This is the thing, is brands do not die. Until ChatGPT wipes away SEO, a digital brand that's been around for a while will not technically die.
Mashable's a good example. I'm man, Mashable's still fighting the good fight. What's going on there?
Mashable right now, I'm pretty sure. I would like to get Ziff on here to talk about it. I'm pretty sure Mashable is the most profitable it has ever been in its existence. And there's a lot of people listening to this who are Mashable still exists. And it absolutely exists. It is using all of that SEO juice in order to do a lot of affiliate, and it's just you milk the SEO and away you go.
Yeah.
So what are the kinds of how has your client base though changed? Because what I end up wondering, I guess there's two sides of it, right? So there's how the client base has changed, because crypto was the apes and stuff like this. I know all of us I was crypto curious, so I'm not gonna throw too many stones. I didn't buy an ape or anything like that. I'm not that crazy, but I was in Miami. I'm not perfect, and there's that, right? So the client base totally changes, but also a lot of this meme stuff. Was this a zero interest rate phenomenon too? Because look, everyone's into the stock market when it's up. Dave Portnoy was doing his, Davey Day Trader. I haven't seen Davey Day Trader. He seems like he's retreated to doing his pizza reviews and taking pot shots at women's college basketball players.
Yeah. Look, I think there's a component of it being a zero interest rate phenomenon, COVID and the stimulus checks and sitting around and people being bored and having more access than ever to ideas to be able to invest in. I mean, you're seeing the legalization of sports betting come across the country. So I think, it is a component, but look, memes are here to stay. I think the scale in which they're able to affect, all of America, obviously that contracts and grows. But I think even as you look at Q1 of this year, you're seeing a ton of retail inflows into the stock market. You have to remember that, unfortunately, for the folks who have jobs, I mean, obviously there's been a lot of layoffs recently, but even if you look back to pre, 2018 area, like, people are getting paid every 2 weeks. They're putting money into the market, and they need help on where to put that money into the market. So there's always going to be that flow into investing. So that's where, this stuff is here to stay. Robinhood has 20 million active brokerage accounts. There's 150 million active brokerage accounts open in America right now, and that's growing. So like people are still investing a lot. Now, how they get their information and how they're persuaded to invest in different, ideas has changed and evolves every day. But I think the craziness, look, there's this saying, so there's in the stock market, there's this, there's a thing called the VIX, which shows how volatile the stock market is. They say a rising VIX drives clicks. When you see the CNBC markets in turmoil, that's when it is
bloodbath.
That's
sure.
Because then it's Michael Berry sent out this thing the other day saying that after all this banking crisis, retail's there to buy it. Retail's buying Bed Bath & Beyond right before they're on the brink of bankruptcy. Like people are looking for the action. So when markets are moving, that's when there's the most amount of excitement. But still, every day there are people that are investing in ideas, and that's where we're really looking at where are the base that's there. And then when we have those big blow up moments, that's when our business does really well. So, the clients that we have will always kind of come and go because they're also the byproduct of VC investments. So we have a ton of VC backed fintech companies that are, actively spending with us to acquire new customers. And the types of those companies come and go. Some stick around for a while, some don't. But that's the nature of the beast. And then we also have, since expanded into other, ancillary type client categories, anybody that's looking to reach affluent people, right? And that's where I think, these people have a lot of liquid dollars to spend. And that's where you open up, the apparel and high value e-com, and there's a lot of that.
I mean, you're going to get your most, when it's a bull market, you're going to go for the endemics.
Right.
And particularly when there's a land grab going on in crypto, like people can talk about like sustainability and stuff like this. Let me tell you, if you didn't run to the crypto and you're everything, that's like an IQ test. Like there's a shit ton of money available, and it's very motivated money because it's all about like trying to establish this, it's a land grab, and picks and shovels are always good during land grabs. So you're now going into like, non-endemic categories, obviously with, just basically this is high net worth, but how is the mix of the work that you're doing different? Because like, I remember back in those days, like it was like, okay, you can like just run like some Instagram stories ads and stuff like this, and FTX would,
totally.
That's great.
And it would just work too. The thing is that when there's a lot of excitement in the market, the cost to open up a new brokerage account is in the single dollars, and then all of a sudden it's the bear market and everybody doesn't trust anything, and then the price is 10x. So what we've seen and what we've done as a business is it is beautiful to have the transactional advertising revenue that comes in from newsletters and other creator sponsorships, because we get a ton of deal flow and we see the performance on what's working, what's not, who's renewing, who's not, and why. And what we've been able to do is then identify the people who are doing really well as a business and then go deeper with them. So what we've done is half of our business has turned into production and other types of consulting, where we're actually helping companies produce their YouTube content and strategy, which then spits off all the short form content, which establishes trust for their brand. It allows them to take advantage of all of the organic channels that are blowing up. We have a very kind of old school B2B company that we do all their production for, and we're seeing, we'll put out an Instagram reel that'll do 100,000 views organically without any paid, and we're showing them that there's a ton of value in that, while also being able to run direct advertising. And you have to build your funnel. So much of the last 2-3 years of all of the VC money running into crypto or fintech has been on cheap cost per acquisition costs. All these companies were run by engineers, and they think they can hack marketing. They think, I give you $100, I'm going to get $300 back on that email newsletter. And the reality is that doesn't work. And if it does, it's a lightning in a bottle, and then you're going to hit saturation level with that newsletter. So you have to keep finding more. And at a certain point, you have to take a step back and realize there's only so far that your affiliate programs and direct response are going to get you as a brand. And I think you start to see like FTX and Robinhood, then all of a sudden the television ads come in. And then you start to see, hey, we should go and do bigger, more brand building. We need people to trust us. So we're helping educate brands on the value of going further up funnel. And, it might not have a direct ROI tomorrow, but they're starting to see month over month, wow, this is a compounding asset of building our own audience. And I think you saw Josh Topolsky recently, who is the founder of The Verge and Vox Media, recently tied up with Robinhood to help take Robinhood snacks and build more of a media company around Robinhood.
Yeah.
Because at the end of the day, Robinhood makes their money when more people are trading stocks. And they need media to drive that engagement, because you can only have your app and push notifications help you out so much.
Right.
You have to develop a real relationship.
Although I think like the opportunity, I sort of like, flicked at this a little bit today, because I do think I'm like obsessed with zero interest rate phenomenons, but I do think like one of them was this idea of go direct, like from tech firms, because like I'm eagerly awaiting the second installment of the DGen trilogy from Coinbase Studios. I don't know when that's dropping. My guess is never. And all of us, I don't think culture is going to suffer because the second and third installments of the DGen trilogy based on the Bored Apes is never going to see the light of day. I think that's probably a good thing. But I think the opportunity it provides is, like you're saying, like a lot of these companies to me got over their skis with, we're going to build media, we're going to go direct, we don't need to blah, blah, blah. You know what? Media seems so easy when you're not in it. I mean, I don't say that I'm going to build some sort of fintech company. I don't know why they think that media is so easy. I guess because they can tweet and do some clubhouses.
That's it.
But like, so you're going to end up being like providing a lot more agency services though. I mean, that's like both good and like also risky.
It is. Look, we're here to make money every day. We have to look at our P&L. I have to make payroll every 2 weeks, and it keeps me up at night. But ultimately, yes, it's doing that. And then where we see opportunity to make investments in content, we just launched a show called This Week in Money with myself, Mark Moran, and a comedian, Sharina Shahidi. That's an owned and operated asset. And then we're able to put those through the distribution pipes that we have and then make a return on the investment there. So as we start to see traction for those shows, we can double down on them, invest more in them so that we can create our owned and operated media. And then furthermore, an area that we've been excited about is also making some small investments off our balance sheet. So when we do have, extra money that's there, we've made investments in technology that, because we know we're not developers, we don't have engineers on staff. But then when, Tyler from Beehive, who is engineer number one at Morning Brew, comes along and says, hey, I want to build this platform to help, creators launch email newsletters, we put one of the first checks into that, and then ultimately helped introduce him to our network of investors, who then ultimately Howard Linson from Social Leverage, who led the round there. And that's, I think, part of our entire company's flywheel, where we've got the transactional email newsletter creator work, and we know what the needs of the creators are and the advertisers. When we see success, we can then double down and either go deeper with the brand or go deeper with a potential technology partner and make an investment. And I think that'll start to compound over time, and it already is. And we're in this for the long haul. This is not like this business is not getting set up for a quick sell. It is, it's very much like I don't say a lifestyle business, but we want to be in control of our destiny and pursue ideas as they come our way.
And look, when you're bootstrapping a business, you just got to make a different set of decisions, and you have a different set of trade-offs than other companies. There's a ton of upsides, but at the end of the day, you have some constraints, and sometimes those constraints are good, and sometimes those constraints are not. And
we have to stay focused, because we're already in so many different areas to monetize our content that we're already spread so thin. And, I battle with this a lot. Are we staying focused enough on what we're doing? But it's like, if I had VC money, oh man, I would be fucking all over the place doing stuff that I don't even know why I would be doing them, but it keeps us grounded.
You'd be doing parts 2 of 3 of the DGen trilogy.
I'd have fucking 10 NFT projects. They're all zeros, and my family asking why.
Dude, by the way, on that, just like since we're on this, like I find so fun, like they just had the Metaverse Fashion Week, and what's hilarious to me is all of these, how it is, like all of these brands the cycles are so long for getting anything done at brands is that they're stuck with these Web3 projects that their sunk cost is like, oh shit, we put so much money into this. And like, God, I wish we didn't have to go through with this. But like, at least that's the way I'm looking at it. Cause I see like GQ coming out with their Web3 thing. And I'm like, oh my God, it's so brands to arrive at the party, like not like a day late, but like 6 months late.
It's wild. And I saw that cycle advice. I mean, our sales cycle for big deals was 6+ months. And it's like, we made content 6 months ago that are finally going live. But I was in Miami for Art Basel, and I was on I sat in on a panel talking about loyalty and the intersection of Web3 with a bunch of big brands. And it was like comical because the brands that are on the stage, some of them were publicly traded companies. And they're talking about how they can start to use Web3 and all this loyalty mechanism. And I'm like, why are you guys not looking at the fact that you're a publicly traded company that have, in some cases, hundreds of thousands of individual retail investors that they have no idea who they are, which is where on the equity animal side, an area that we're so excited about is really starting to unpack the technology of the stock market. People can go and buy a share of Disney right now, but Disney does not really know who that person is. And that is the start of true loyalty versus getting involved in these like financially driven Web3 art, weird non-core part of their business where it's like, what department is that helping? Because I always struggled with that. Like, what is this just an innovation budget gone rogue, or like, like I get worried about that for big brands.
Yeah, I find that actually interesting about the equity animal project because you think about it, like you look at like what happened with, you know, and I think about you know, obviously GameStop and then also with Wall Street Bets, and also it's what went on with AMC. But then also you look at like Substack and this crowdfunding campaign, which we were both fellow investors in Beehive. Mine's a little small, but like, you know, I didn't invest in the Substack crowdfunding mostly because I'm like, I don't invest in something where they don't show the financials. Like I'm not that, I mean, my God, not that much of a mark. But I think what that shows, because they raised a lot of money, and it is that there's an opportunity, I feel like, for companies to collapse that thing between their like customers and their owners and stuff like this.
Yes, and there was a big legislation passed during the Obama era called the Jobs Act, which basically started to look at the definition of what it means to be an accredited investor. For the longest time, it was straight up illegal for a regular American to invest in a private company. And what they were able to do is launch something called a Regulation A, and then there's a couple other versions of it, Reg CF and others, which allow companies, startup companies, to solicit investment from retail investors that are not accredited, so regular people making regular amounts of money, and invest in these companies, which is so exciting because anybody can go to Vegas and gamble as much as they want, but you couldn't invest in companies. So that regulation has paved way for a lot of exciting, companies to pop up, such as Start Engine, Republic, and WeFunder, and then have companies be able to open up access to invest in them, via these regulated portals. And Substack is taking advantage of Regulation CF, which allows them to raise up to $5 million from regular people. I have a lot of thoughts about, that strategy for them at that valuation.
Tell me. You're in favor of it?
I am absolutely not in favor of it. Look, at the end of the day, when you're investing, valuation matters. And I think you really need to understand the entry point that you're getting in at. And I was running some numbers the other day. So they're raising at basically a 10% discount from what the last round, which Andreessen Horowitz came in at. I saw a ton of good.
That was like what, like 650
or something.
Million?
They're raising at 585. And I was looking back, I was like, there's so many like intersections of Substack and like Medium.com. And Medium last raised, I think, at a $500 million valuation a couple of years ago. And like that was a big L. And look, I think the comp that everybody looks at is MailChimp getting acquired for what, like $20 billion by Intuit, which I think that entire business was bootstrapped, amazing exit.
It was bootstrapped.
It was wild. They became, I think, two of the most wealthy people in America. But then there was a ton of pushback about how they didn't give anybody.
Well, yeah, they sold it for $20 billion. They had like employees there for like 30 years or something.
And then
like
Intuit
this.
had to issue like some stock after the fact. But on the Substack front, it's just, you look at these VC-backed businesses that are down, like they're raising rounds at less than 50, in some cases 90% decreases in their valuations, and they're not showing any numbers. And it's just they're basically asking for donations from their audience.
Right.
And
yeah, I just did. This is going to come out
Yeah.
a week after a podcast I did with Chris Best, and like we talked a little bit about it. I'm more interested in how it will change their roadmap rather than anything, because like what I think about, I'm selfish, so I think about it as someone who publishes on Substack, and I'm like, this is going to force them to make bad decisions that are against my interests. That's basically my message on this front.
That's if they're also still around. Nobody knows what their burn is. Like, are they going to be in business in a year? Like, that's where I'm like, why do they need this money? And it's only $5 million, but they're Yeah, I don't know. And also, I think when you look at the actual core product, like some of their bigger writers are churning. You know, when like they were, you know, when they took on all that VC money from Andreessen, they were writing all those Substack Pro checks. I think a lot of these early investors that are very loud on Twitter talking about them investing it, I think they're just taking part of that check that they got and investing it back in the company, and they're just giving it back to them. And it's just like, it's a head scratcher, honestly. And I think it's unfortunately, you know, those are the example companies that just like, I mean, look, all the luck in the world to them, but if they don't get a good exit, it's just they're burning their audience, and that'll just have a compounding effect with people leaving. And then if a VC has to come in and dilute them further, it's going to create a lot of weird dynamics that let the VCs take the risk. Don't put that risk on your community. Especially ones that are very like, you know, new on your platform. I get nervous about that.
Yeah, that's fair. All right, let's leave it there. This is a great meeting of the Brians. I appreciate it. You know, are you alarmed? You're actually one of the younger Brians out there, because this is a name that is it's dying out. I don't know, like nobody talks about it, and it bothers me that this is not like, I know we have a lot of things we're dealing with right now, but I'll send you the chart of, you know, Brian's, and it like peaked as like a name like right when I got it, like 1973, and at this stage it is pretty much, I think, on track to die out by like 2060.
Oh no, that's a bummer. My mom was about to name me Kevin, but I was happy she named me Brian, especially with an I, not a Y.
Yeah, I know. Why? That's very Canadian. All right, cool. Thank you so much,
Brian. We'll talk soon.
All right, see ya. Thank you all for listening, and thank you to Jay Sparks of Pod Help Us for producing this podcast. You should check out Jay and his services at podhelp.us, and we will be back next week, new episode.